Morena, gentlemen. Welcome to another glorious day of online learning. So today we're going to be looking at the product life cycle. Now the product life cycle is a model, and you know how we love models in commerce, which describes the stages a product goes through from when it's first thought of right until it's removed from the market. Now we can see our model down here. It has on its y-axis sales over time. Obviously, the higher up this line goes on the y-axis, the more sales that are being made. And then along the x-axis, we have the different phases of the product life cycle, or the different stages. Now, prior to any sales occurring, we have the research and development stage. And this occurs actually outside of the model, but it's an incredibly important part of the product life cycle. So it occurs before the product is made available to sale, and that research and development might be occurring in a lab, might be occurring through the business testing its products, or samples on focus groups, and really trying to get an understanding over how a product could meet the needs and wants that they've identified in their target market segment. So once that product is ready to go, it's launched into the market, and now that's when sales are going to occur, and we call this the introduction stage. At the introduction stage, early adopters buy the product first. By early adopters, we're meaning those consumers who are willing to try out a new product, be one of the first people to test whether that product meets their needs or wants. These are often bold individuals, people who have a really pressing or high need or want that needs to be satisfied, and they're going to go out there and try the product, even though it doesn't have much of a sales record at all. And we can see in our product lifecycle model that sales are low at the introduction stage, but they start to rise. They start to rise as the product gets more credibility and more people start to hear about how early adopters have been satisfied by the product. Now, after that introduction phase, we move into the growth phase. Now, during the growth phase, we can see that rates of sale increasing at an increasing rate. Now, this occurs because those early adopters have had a successful experience with the product, and that product awareness is building throughout the market. Through word of mouth and advertising, people are becoming aware of the product and that it can successfully meet a need or want, so they start purchasing these. And these include mainstream consumers. Consumers like myself who aren't too risky with the products they buy, often look up product reviews and see whether or not it's a hoax or whether it can actually satisfy a need or want. So at that growth stage, sales are rocketing up. Now then, once that growth stage is finished, we're moving into the maturity stage. We can see that sales are increasing, but at a much slower rate. And they also reach a peak, and this might occur at the back end of that maturity phase before they actually start to taper off or decrease slightly. And this comes about because we've got competitors in the market. So in those earlier stages, it's likely that there's no competition in the market for us to deal with, or there's few competition. But once you reach that maturity stage, there's what we call saturation. The market is saturated with competitors because businesses have become aware that this is a market and a product that is satisfying customers' needs and wants, and they're going to get a piece of the action by creating their own version of the product. Also, there's a bit of a decrease in that rates of sales rise because customers' needs and wants evolve. And there's going to be potentially technology changes, which mean there are substitute goods that are being introduced to the market that are actually themselves at that introduction and growth stage. So consumers are going to be moving towards considering the competitors' products at that maturity stage. Now the final stage is decline. Now decline, as the name suggests, sees our sales declining. They're declining due to competitors potentially offering a better version of the existing product, or there's an alternative product that satisfies the same need or want. And that might come about because that technology change. Or perhaps consumers no longer have that want or need. And the product sales will continue declining until it reaches a point where it's simply uneconomic for the business to continue offering that product for sale, and they'll withdraw it from the market altogether. And we'd call that the product becoming obsolete. So it's no longer adequate or satisfying the needs and wants of consumers. Now, not all products reach this final stage of decline, and we're going to be looking at extension strategies that businesses use to keep their sales growth positive and to keep that maturity phase enduring. Now, profits are also going to change throughout this product life cycle. And here we've got the green line, that's our traditional product life cycle curve, and that's reflecting sales. Now, our purple curve here, that reflects profits. Now, on this model we've got here, we've included product development to show us how our profits are going before the product reaches the market. So businesses are often making a loss at that introduction stage. They do that because of high promotional costs. So they're out there marketing their product. They're spending a lot of money on making consumers aware that their product exists and how it satisfies their need or want. The business is also likely to use penetration pricing, or potentially penetration pricing rather, because they want to persuade customers to try out their product. Customers don't have any existing faith or trust in the product performance, so charging a really high price is unlikely to help the business make sales. They might need to come in and offer a lower price. Also, there's going to be likely higher costs per unit that's produced due to a lack of volume. Now, when a business is producing or mass producing their products or producing lots of volume, they can buy the raw materials in bulk. And if you'll appreciate from going out and buying consumer goods in bulk, it's cheaper to buy more of the product on a per good basis. So buying a 24 box of Coke, cans of Coke, you'll notice that the per can cost of Coke is lower than buying the can of Coke individually. And there are also some other costs that are lower on a per unit basis. We call these economies of scale. And if you stick with studying commerce, you'll no doubt look at economies of scale in a bit more depth. Now, as the business moves into that growth and maturity phases, this is when they're making the majority of their profits. And it's because the sales are high and the business is likely to be able to increase their price. They've already penetrated the market and they've got that trust, that faith in the product performance, so they can start raising that price. As they do that, their profit per unit rises, and also as the volumes increase, their costs per unit falls, which means that rising price and falling costs per unit is going to add to an increase in profits. Now, at the back end of that maturity stage of the product life cycle, you're going to start seeing a decline in profits per unit. This comes about because of the need to implement competitive pricing. Now, the business is going to be facing competitors now who have seen the business introducing this wonderful product and has decided to copy or emulate them with their own version. And the business has now got to use competitive pricing to stay attractive to consumers. So in decreasing their price, it's going to be decreasing that profit margin. Additionally, with the competition in the market, we're going to see an increase in promotional costs. We're going to be doing this because we might be using offensive or defensive marketing strategies to try and differentiate our product from the rest of the market. So with higher promotional costs and lower pricing, those profits are going to start to fall. As we're moving into the decline stage, our profits are getting increasingly squeezed because our good is less popular. And then ultimately, once we're at the real conclusion of our product life cycle, we may even be selling at a loss. And this is to clear or get rid of the obsolete stock. So it's right at the end of the product life cycle. We might think about some consumer electronics. That when we go to a consumer electronics store and we see potentially a model of a phone or a laptop that's been on the market for several years, and we note how much cheaper it is than when it was originally released to the market. And the business in this case might even be selling at a loss because they simply want to get rid of the stock and cover some of the cost of production that they've already incurred in producing the good. So if they gave it away for free, they'd make a much bigger loss, or not selling it at all, they'd make a much bigger loss than selling it for a reduced price. So here we've just got a summary table of our different stages of the product life cycle in terms of our sales. We can see going through our developments, this introduction here, guys, as well. Slow, heavy, they flatten out, then low again. Competition, well, there's not much competition at the start. Then that builds up to being fierce. Lots of competition at that maturity phase. And then it starts to decline a bit to low and medium as our competitors also start seeking out other opportunities. Now, different marketing strategies here. So at the start, we might want to be explaining our products, so informative marketing. Reach out more people, so mass marketing strategies potentially. Maybe we've actually properly identified our target market segment, so we've worked out better ways to reach them. Here, show our product is unique. So probably also going to be doing a bit of persuasive advertising here, and then marketing at the back end of the decline. We're just trying to get rid of the outdated products. We're probably going to be using a bit of informative advertising as well, letting customers know about the greatly reduced prices. In terms of pricing, here we've got market penetration. So penetration pricing, as we discussed earlier, could be quite low, or price skimming. And we looked at price skimming as well. It's how a business can start off with a high price for those early adopters, and then gradually drop the price over time to capture as many sales as possible. And we see this with smartphones. If you notice how expensive smartphones are at the start, and then their model will decrease their price. Then we go to competitive, then discount pricing, right to the back end of that decline stage. Today's activities, guys, to complete task 19A and B on page 33 of